So if the cab driver sell his car to the other party means now he don't have the insurable interest. The insurance company is going to get insured with another insurance company. So that is called reinsurer. Insurable interest means only for the physical object you can claim the insurance, as well as for this the ownership plays an important role. Hello everyone, a warm welcome to one and all. I am Meghana from the Department of Commerce, lecturing in Vidhyaashram First Aid College, the Temple of Excellence. So today we are in the session 3 of Unit 1, subject Principle and Practice of General Insurance. In the last session, we have discussed about the types of general insurance and the evolution of general insurance. In today's session, let us continue with the fundamental principles of the general insurance, then recent innovation in the general insurance, then organization of general insurance company, as well as the regulatory framework for the general insurance in India. So let us start with the fundamental principles. So there are some principles for the general insurance. So under that first one is principles of ubemia fidia, that means utmost good faith. So principles in general, principles of utmost good faith. The name only says here in the insurance contract, both the insurer as well as the insured, insurer and insured, both the party should sign the contract based on the trust and beliefs. So they should disclose the information. They should disclose the information with each other. Then they will sign on the contract. So utmost good faith between the insurer and insured here. So here based on the trust belief, the contract will stand. So you need to give the detailed information or the fair information in the insurance contract. So here the insurance or the good faith, that means the trust, plays an important role. So both the parties should sign the contract based on the faith and beliefs. So next one, principle of insurable interest. Principle of insurable interest means here the insured, the person who is insured with the valuable things can claim the insurance only for the object, only for the physical object or the object which is physically exist. So existence of the object will give some benefits for the insured. The loss of such object may cause losses for the insured. So only for the physical object or physical existence can claim the insurance. So for the insurable interest, it should have the insurable interest. For example, taxi cab driver has the cab. So through this, they get some income. So the cab driver will receive the income through the cab. So the loss of cab will cause losses for the financial risk for the cab driver. So here only for that physical object you can claim insurance. Here also the ownership plays an important role. So if the cab driver sell his car to the other party means now he don't have the insurable interest. So insurable interest means only for the physical object you can claim the insurance, as well as for this the ownership plays an important role. So the ownership as well as the physical object or physical existence plays importance under the principle of insurable interest. Next, principle of indemnity. Principle of indemnity means it is a protection for the uncertain risk or losses. So it is a protection, compensation from the insurer to reduce the financial risk of the insured. So here the insurance company is going to compensate only for the damage or losses occurred. Insurer or insurance company is going to compensate only for the loss occurred due to uncertain risk. The main intention of this general insurance is to reduce the uncertain risk or the damage for the insured person. So here they are going to compensate only for the uncertain risk. So in this case, they are going to compensate to the sum assured or the actual losses, whichever is less. So they consider the amount assured or the sum assured as well as the actual loss. So whichever is less, so they are going to compare this two. So the main intention is to reduce the financial risk. So only for the fair reason they are going to compensate the insured product or insured valuable things. Principle of contribution. Principle of contribution means both the parties, both the insurer as well as the insured person has to contribute to meet the uncertain risk in future. So only the insured person is not going to invest or contribute. So as well as the insurer has to contribute some proportion to the premium or some proportion to the investments. So both the parties should contribute towards to meet the uncertain risk. That is first things. Next thing is, if the insured person or if the person is get insured the valuable things from two insurance company or more than one insurance company, so now they have a liability or he has the right to claim from only one insurance company. For example, insured or a person is insured their valuable things from the insurance company A and B. So at the time of uncertain risk, he claimed 100% compensation from the insurance company A. Now the person is not have a rights to claim from the B. So he cannot claim the 100% compensation and he cannot make profit. So he can claim from one company only. So at that time, if the insurance company compensate the insured at 100% means this company A have the right to receive the proportion of contribution from the other insurance company. So it's clear that if the insurer or if the person get insured from one or more insurance company, he has the right to compensate from only one insurance company at a maximum level or at 100%. So at that time, the insurance company has the right to receive the contribution from other insurance company. So he cannot claim from two insurance company and make a profit. So the main intention of this general insurance is to reduce the losses and reduce the uncertain risk. So he cannot make profit out of this insurance. He has a right to receive from one insurance company, not from both the companies. So this is all about principle of contribution. Next one, principle of subrogation. Principle of subrogation. Principle of subrogation means substituting one creditor with other creditors. So at the time of uncertain risk, the insurance company is going to compensate for the insured. So at that time, the ownership or the legal ownership is transferred from the insured to the insurance company. So this happens only if the damaged goods have some value or the insurance company can make profit out of that goods or the valuable things or the damaged goods. So at that time only the insurance company is going to take over the damaged product or damaged goods. So here substituting the creditors, the ownership is transferred from the one person, that is the insured, to the insurance company. So here the transfer of ownership, substituting the one creditor to with another. Next one, principle of loss minimization. Principle of loss minimization means it's a duty of an insured to minimize the loss. So he has to try at a maximum level to reduce the losses. For example, if you are traveling with your two-wheeler, so you need to check your vehicle condition before you start your travel. So you need to check. So at that time you can minimize your losses. So if due to brake failure you met with an accident means you have a chance to reduce that losses, but you fail to do it. So at that time the insurance company is not going to pay you the compensation. So the insured person has to try at his maximum level to reduce the losses. So you need to try to minimize the losses. So in any other cases you need to try at a maximum level to reduce the losses. So due to uncertain risk, or if you cannot control that situation means, then the insurance company is going to claim, or the insurance company is going to give you the compensation, but not in this situation. So you need to try at your maximum level to reduce the losses or to minimize the losses. Then principle of causa proxima, that means nearest cause. So if the uncertain risk or if the uncertainty or the damage occurs due to one or more reason, the insurance company is going to consider the nearest fact or the nearest cause for that damage. So based on that factors is going to decide whether to claim the insurance or not. So they will consider only the nearest fact, nearest cause, not the remote factors or the remote causes. That means the far factor or causes. So here these all are the principles of general insurance. So here you need to based on the good faith, that means utmost good faith, that means at the time of uncertain risk you need to disclose the detailed information. So if the insurance contract is void means why it should be cancelled or why the insurance company cannot claim the insurance. So what all are the factors, what all are the conditions they need to disclose. So utmost good faith you need to agree with each other and then sign for your contract. Then insurable interest, only for the physical object you can claim the insurance and it should give benefits for the insurer or insured. Then indemnity means the main intention is to reduce the losses. They will consider both the sum assured as well as the actual losses. So based on that, whichever is less, they are going to consider that amount. So then contribution, both the parties should contribute and the insured has no right to receive the compensation from two insurance company. Then subrogation, the ownership, after the compensation is paid, the ownership is transferred from the insured to the insurance company to get some benefits out of that damaged product. So if the damaged product has some benefit or some value in future means, so the ownership is transferred. Benefit should be equal to the compensation paid by the insurance company. So then only he can, the ownership is transferred from the insured to the insurance company. Then loss minimization. Loss minimization means the insured try at a maximum level to reduce the losses. Then last one, nearest cause. They will consider the nearest cause rather than the remote cause. So this is all about fundamental principles of general insurance. Moving further, next topic is recent innovations. So the various innovation in the field of general insurance. So due to various reasons, it has evolved or innovations are happened. So everyone should flexible in order to adopt the changes in order to sustain in the market. So the recent innovation in the field of general insurance is a deeper evolving technology in insurance process. So due to technology, changes in technology, so they are come up with the innovative ideas or new ideas in the field of general insurance through the artificial intelligence, big data collection, then various factors, the various items like machine learning. Through the various technology, this helps to develop in the field of general insurance. So through all this technology, the insurance company or the company can get the information easily based on the requirements of the customers, so that they will collect the information and they can handle with this technologies. So due to technology, changes in the technology helps to innovate in the field of general insurance. Technology plays an important role in every field. So in general insurance also, it plays an important role through the artificial intelligence or the machine learning or big data collection. Through all these factors or through all this technology, it helps the insurance company or the insurance field to improve themselves, to improve their service in the field of general insurance, so that they can attract the customers and it helps them to serve better. So technology is one factor which helps to innovate in general insurance. Next one, customized product offering and transformed customer relation. So in current situation or in modern marketing or in modern business, the customer relationship plays an important role. now will treat the customer as a god. So you need to satisfy the customers. That means you need to satisfy your client. For that, you're going to customize your product or services based on the requirement, based on their requirements, that is needs and wants. You're going to customize your product. In this general insurance, you're going to modify your policy. So premium amount and the sum assured based on the requirements of the customers, you're going to modify your insurance policies. So earlier we don't have that flexibility. Now we are flexible to adopt the changes, or we are going to modify the product or the services based on their requirement. So the main intention is to maintain the good relationship. So the transform customer relationship. So you need to maintain a good relationship with your customers so that you can earn profit as well as the customer is also benefited through this business. Next one, gaining momentum from the regulatory changes and government initiatives. Through the government initiatives, gaining momentums. So now in the general insurance, under general insurance we have various types. So from that, health insurance, then crop insurance, then motor insurance plays an important role. So now health, crop as well as motor. These three insurance plays an important role in current generation. So now we give preference for our health. So we need to secure our health. That means our medical bill or the medical expenses. So in order to avoid the financial risk in future, to maintain your health, so this health insurance plays an important role. Majority percentage of people prefer to purchase a health insurance. The ratio investments in the health insurance is increased. Then crop insurance. Crop insurance is mainly in order to protect our farmer with the help of government. So we can safeguard or we can reduce the financial risk for the farmer with the help of government initiatives. That is, Pradhana Mantri Fasal Bima Yojana helps the farmer to reduce their risk. So it reaches 70% of the farmer. So it to reach all the farmers. So through this crop insurance is also an important role in Indian economy. So next one, motor insurance. Motor insurance is compulsory in India. So nowadays at the first stage, that means in the showroom only, we get the insurance for 3 years and 5 years, as well as the third party insurance. So the various insurance is available for the motor vehicle in order to protect your motor vehicle or the damage for motor vehicle. So this three plays an important role in innovation or in recent innovation in the field of general insurance. So they gain momentum for the regulatory. This plays an important role in Indian economy. So now the percentage of investment for this three insurance is higher. So it also plays an important role. Then other recent innovations. So other recent innovation, it may be apart from this, other apps or other insurance types which is provided from different private sectors or private insurance company in order to protect the financial risk for the insured person or for the general public. The other recent innovation are, first one, CUVA. CWVA. CUVA. That means it is an insurance to protect the vehicle or car. So if you are borrowing car, you need to protect your vehicle from the uncertain risk. So it provides hourly insurance for your vehicle. What the vehicle you are borrowing, for that hourly insurance. So they're going to provide you an hourly insurance for your vehicle. So all you need to do is with the app you can insure your vehicle. All you need to do is you need to register with your mobile number. You need to enter your registered mobile number, as well as you need to write an approximate amount for the car, as well as you need to upload the car image, so that you will get that you will get the insurance. You will get the insurance. They are going to check your driving license and other factors to provide that benefits. So now you can fix or you can insure your vehicle only for a particular period, like 3 hours, 4 hours, or 1 day, 2 day, 1 week. For a particular period, you can insure your vehicle. Your vehicle means borrowed vehicle. You can borrow it from your friends or any other from anyone. So for that you can insure for a particular period. So through this KUA you can benefit or you can insure your vehicle for a particular period. Next one, digital risk. Digital risk, it is an insurance. It is designed for the tech companies in order to protect their information like laptops and various important factors. So it provides benefits or it provides protection for their valuable information in companies. So digital risk. Next one, back me up. Back me up, it's an insurance in order to protect the youngster as well as the students. So for example, for a 15 euro, you can protect 3 most valuable things. So for example, mobile phone, laptops, any other valuable things for the youngsters as well as for the students. So through this insurance, you can get benefits or you can protect your 3 valuable things. Next one, Go Girl. Go Girl, this insurance helps the women driver. So this insurance is mainly to protect the women driver from uncertain risk. So they can provide their vehicle. They can provide vehicle for them in particular situation, or they can give benefits or they can help them in a critical situation. Next one, Ppgi. Ppgi is the insurance in order to protect your flight delayed. So if the flight is delayed more than 2 hours, so you can get benefits or you can protect your travel. Through this Ppgi, you can protect your flight delayed. So before 5 days, prior to 5 days of your travel, after your purchase of your flight tickets, you can insure for your flight ticket. So these all are the recent innovation apart from this factors. One is technology and other important factors which plays important roles in the Indian economy, as well as the customized product offering for the customer, as well as the maintaining good relationship. Apart from this, these all are the recent innovation in the field of general insurance. So this is all about recent innovation in general insurance. Moving further, next topic is organization of general insurance company, that is organizational structure of general insurance company. So the organizational structure of general insurance company is, first one, line of business. Next, again they have back office operation, and the main important factors, that is agency operators. So this 3 organizational structure which consists of general insurance company. So under the line of business, so various lines, so they deal with various business lines. So under that, first one is commercial or institutional lines. So the insurance company deals with various line. Under that, first one is commercial or institutional business. So mainly this insurance is for the business purpose. So in order to protect the business properties or in order to protect the business risk, this insurance came into existence. Commercial means only for the business purpose, as well as in order to protect the business property, business risk like warehouse and various storage and various other factors related to business or commercial activity. So this insurance is for the commercial activities. Next, health insurance. So now we all know health insurance in order to protect human beings' health. So in order to protect the public health, this health insurance. So the commercial insurance is a different field and the health insurance is a different field. So general insurance is deal with all these different fields. So health insurance as well as the investment management. So they're going to manage with your investments. So in order to protect the financial risk, this investment management as well as the life. So again, they deal with the human lives. Either they may get benefits after the insured death or else after the expiry date or after the due date. So there are two types under the life insurance. One is after the death, the dependent will get the benefit, or else after the due date or the expiry date, the insured person will get that benefit. So they are deal with life insurance. Again, property and casualty interest. Property and casualty. So property, the valuable things, you can insure your properties like home, like any valuable items within the house or any other properties you can insure. So all this insurance are a different field or different lines. So the insurance company will deal with this different lines in the general insurance. Again, reinsurer. So the reinsurer means the insurance company is going to take the risk to reimburse you. So who will take the responsibility for the insurance company? So then this reinsurance came into existence. Reinsurance means the insurance company is going to get insured with another insurance company. So that is called reinsurer. So here the insurance company is going to insure under other insurance company. Then risk management. So as I told you earlier, every business has risk, but under insurance, the risk is the main business. Risk is main business in this general insurance. So you need to manage the risk. You need to analyze the risk. So all these are different lines, insurance company which deals in this different lines of business. So the various teams or the various departments are there in order to manage all the different lines of business. So next one, back office operators. Back office operators, under back office operations, first one we have a claims process. Claim processing means, so if the uncertainty occurs means you need to claim the insured is going to claim, so you need to process. The various processes are there, the various steps in order to claim your insurance. So this insurance claiming process will happen at the back office operation. So they are going to consider all the factors, so the nearest fact, and they are going to check whether this damage occurs truly or not. So they are giving fair information or transparency in their information or not. They are going to consider all these factors, then they are going to decide whether to claim their insurance or whether to hold or whether to pay their insurance. So all this will happen at the back office operation. Next, investment. So investment means in order to make some profit, in order to make profit as well as in order to meet all their expenses, operational expenses, you want some money. So for that, you are going to invest in other factors like bond, shares and any other collateral securities or any other field like real estate. So you need to invest. The insurance company is going to invest on bonds, shares and debentures, collateral securities as well as the real estate to make profit. So this investment is also going to take place in back office operation. So you need to analyze the factors, then you are going to invest in all these factors to make some profit. So you can utilize that profit in order to meet the uncertain risk as well as in order to meet this expenses or operational cost for this insurance company. Next one, new business processing. So you will get various information or various application for the insurance company. So you are running a business line only health insurance. So if you get the insurance, if you get the application for the crop insurance or any other form like motor insurance or commercial insurance means you can move that information for the appropriate business. So you can move new business processing. You will collect the information and you are going to give it for the required sectors. Next, policy holder services. So you need to maintain a good relationship with your customers so that they can continue with your insurance company. So that you need to provide them some services. You need to clarify their doubts. You need to give full information or detailed information about the insurance so that you need to maintain a good relationship. You need to provide the services for your policy holder at the right time. Then last one, payments and commission. So this calculation of payment and commission also takes place in the back office operations. So the payment due and premium collected, all this you are going to calculate as well as the commission. So here the agent came into existence. You need to pay them commission. So you need to calculate. All this calculation will happen at the back office operation. So next one, agency operation. So here agent plays an important role. So in the insurance company, agent is an important factor. So they act as a bridge between the insured as well as the insurance company. So between the insured as well as the insurance company, this agent is a middleman or is a gap or bridge between this gap. So this agency operations. So agency office administration. First you need to agency office administration. You need to manage with the agency administration. Then agent recruitment. You need to recruit the agent. You need to the agent should have that quality and skills, knowledge in order to communicate, in order to convince your policy holder or the customers to make them purchase your policy. So you need to recruit the agent, as well as you need to give required training as well as the skill for them, as well as agent revenue production. So then the agent start their activity, like they are going to convince the customer or they are going to involve themselves. So they are going to involve themselves in purchasing, or they are going to convince the customers and make profit for the insurance company. This is all about the organization of the insurance company, general insurance company. Line of business, back office operation and agency operation. Last topic is regulatory framework for the general insurance in India. So we want some regulation in order to run a business. In the same way, in order to run the general insurance, we want some rules and regulation for the fair and transparency in the business. So for that, this IRDA came into existence. While explaining evolution of general insurance, I explained you about IRDA Act. So the IRDA means Insurance Regulatory and Development Authority. IRDA means Insurance Regulatory and Development Authority, 1999. So this act was constituted in the year 1999. Before that, the government is formed Malhotra Committee in order to submit the report to form this IRDA Act. So they formed the Malhotra Committee in the year 1993. 1993, Malhotra Committee is formed in order to give the report for this IRDA Act. So they submitted the report in the year 1994. After that, in the year 1999, this IRDA Act was constituted. So this act removes the exclusive power from the GIC, that is General Insurance Corporation. So now General Insurance Corporation has some power for this general insurance. So this IRDA Act removes all the exclusive power. So the only government company, the GIC is the one company which run in the field of general insurance. So now this general insurance is opened up for the private sectors. So now all the private sectors as well as the government companies are participating in general insurance. So this general insurance, this GIC has 4 subsidiary companies. So from the government, directly from the government, this GIC have a control. GIC is controlled by the government, and this GIC control this 4 subsidiaries companies. But after this IRDA Act, this power is removed. This exclusive power for the GIC is removed. So now it is opened up for both the private as well as for the government sectors. So it helps or it guides to the right path. So it helps IRDA Act. It leads to the transparency in the field of general insurance. So they try to minimize the losses for both the insured as well as the insurance. So they encourage for the fair business, to conduct a fair business in general insurance. So this IRDA formed under the Act of Parliament, Insurance Regulatory Act, Development Authority Act 1999 for overall supervision and development of insurance sector in India, for overall supervision. So now we want some supervision or supervisor in order to control or in order to guide our business. So in order to guide and in order to supervise and develop in the field of general insurance, in the field of insurance, this IRDAI means Insurance Regulatory and Development Authority of India. So this IRDA was formed. The power and function of the authority are laid down in the IRDA Act 1999 and Insurance Act 1938. So the power and authority is with IRDA. So now the power and authority is with IRDA as well as the Insurance Act 1938. So the Insurance Act 1938. Now these two acts govern or guide, regulate the general insurance in Indian economy. Next, the Insurance Act 1938 is a principal act of governing the insurance sector in India. So this act is a principal act to govern the insurance sector in India. It provides the power to IRDAI. So this Insurance Act 1938, it provides power to the IRDA Act to frame the regulation. In order to frame the rules and regulation, this Insurance Act provides power for the IRDA Act. So now they have the control or regulatory authority to control the general insurance. So this IRDA adopted a mission for itself, which is as follows. Mission of IRDA is to protect the interest and secure fair treatment of the policy holder. So you need to protect the interest of policy holder and you need to ensure for a fair business or transparency in business transaction. Then to bring out the speedy and orderly growth of the insurance industry for the benefit of common man and to provide a long-term fund accelerating growth in the Indian economy. So they try to speedy and orderly growth in the field of general insurance as well as they try to benefit for the common people as well as for the Indian economy. So their mission is to speedy and orderly development in general insurance as well as to benefit common man as well as the Indian economy. Next, to set, remote, monitor and enforce high standards of integrity, financial soundness, fair dealing and competence of those it regulates. So their intention is to set, promote and monitor, enforce all the general insurance sectors. So they ensures the financial soundness and fair dealings and competition in the field of general insurance. So they establish a healthy competition in general insurance field and fair competition and fair conduct, sound financial business in general insurance. Next, to ensure speedy settlement of the genuine claims. So settlement, it takes some time. So they ensure speedy settlement for the genuine claims. So you need to analyze the factors, then the insurance company is going to claim. But for the genuine claims, you need to settle it fast. So they ensure speedy settlement for those genuine claims. To promote fairness, transparency and orderly conduct in financial markets dealing with the insurance and build a reliable management information system to enforce high standard of financial soundness amongst the market players. So they promote fairness, transparency and orderly conduct in general insurance field. So they form rules and regulatory in order to protect this general insurance from this various risk. Next, to take action where such standards are inadequate or ineffectively enforced. So they take action if the standards are inadequate or ineffective. They will take action. Then to bring out the optimum amount of self-regulation in day-to-day working of the industry consistent with the requirement of the prudential regulation. So they are going to deal with the maximum or optimum utilization of the amount. So they are going to regulate the general insurance sector in India. So they want fair and business or transparency in business in the field of general insurance. For that, they are going to work hard. This IRDA is going to regulate and they have a control over this general insurance in India. Through this IRDA Act 1999, they are going to regulate the Indian general insurance companies or Indian general insurance sectors. This is all about regulatory framework for the general insurance in India. So this is all about your unit 1, that is introduction to general insurance. Let us meet in the next session with the unit 2. Until then, keep watching. Thank you.